Welcome to Learn by Choice. In this video, we are going to talk about evergreening of the loans through alternate investment funds. And this process of evergreening through this AF route may no longer be possible because of the recent directives or the guidelines issued by the Reserve Bank of India. Lot of regulated entities by Reserve Bank of India, and these regulated entities mostly they are all financial institutions, whether banks or NBFCs or housing finance companies. Now they cannot invest in the alternate investment funds. These funds have ties or maybe relationship to the companies where the banks or the financial institutions have given loan. The banks and non-bank lenders and the home financiers are not allowed by RBI from investing in specific kind of alternate investment funds. So the investments not allowed in certain types of alternate investment funds which are connected to the companies that have borrowed the money from these lenders which are regulated by Reserve Bank. So the Reserve Bank of India, they have flagged transactions of the alternate investment funds, and they have issued guidelines to address certain important concerns. Evergreening of the loans is the unacceptable practice adopted by many financial institutions, where the banks and financial institutions they shift their direct loan exposure given to any companies and borrowers through alternate investment fund investments. Alternate investments have invested in a debtor company of the bank, then the lenders must sell their investments in these AIFs within 30 days. So investments in alternate investment with a priority distribution model are to be fully deducted from the lender's capital. Priority distribution model where the limited partners are the investors in these alternate investment funds, they receive the priority payout. So these kind of investors, they get their principal and investment back before other investors. The issue raised by Reserve Bank of India here is there is disproportionate loss to the holding of one class of investors. So the measures of Reserve Bank of India towards the alternate investment funds is basically to curb the evergreening of the loans. So evergreening is a practice wherein the new funds are provided to the borrowers who are unable to repay the existing loans so that they mask the true financial health of the borrower. If a bank or NBFC owns units in alternate investment funds that have invested in companies to which the banks and financial institutions have also lent the money, then they must sell out those loans within 30 days. If a bank, for example, if they continue that investment in the AIF beyond 30 days, then those financial institutions and banks must make provision for the entire amount of the investment. So this provision is in anticipation that the loan may turn into a bad loan. So what is the priority asset charge in AIF contracts? So the AIFs secure its first charge on the assets if the borrowing company goes bankrupt. So AIFs would have the priority over the bank or NBFCs in recovering the assets in case of default. So the banks will not get their money, but whereas the alternate investments will get the money back. So if that kind of provision, priority asset charges exists in the AIF, then the banks should provide additional capital for the loans which are lent to the borrowing company. So what is the possible impact of the Reserve Bank guidelines as far as the REs and AIFs are concerned? There will be surge in the credit cost, and there will be disruption in the fund flows into the AIF, and reduction in the portfolio entity selection and impact on the net worth. Immediate liquidation of the AIF investments with exposure to the debtor companies within 30 days. Then future limits to a maximum 30 days is linked to debtor companies. Beyond 30 days, they cannot have the limits. And provisioning, banks and NBFCs have to make the provisions for specific kind of AIF investments as mentioned. Then there are some kind of unintended outcomes. So there are banks which are having legitimate AIF investments. So what are the overall effect of it? Brings the NPA out, and also masking of the NPA may not be possible, and the risk mitigation, it minimizes the conflict of interest, the borrower and the banks, and also proper identification and recognition of the NPAs, and also it reduces the risk of evergreening of the loans, and integrity of the financial market will go up, and it also addresses the loopholes and prevent manipulation of the loan portfolios by the banks and financial. So what are AIFs? Pooled funds which are invested in hedge funds, private equity and venture capital. And these AIFs are basically formed either through a company or maybe LLP, limited liability partnership. And there are three categories of AIFs. Category 1, they invest in SMEs and startups and economically viable corporations which are having huge growth potential. Category 2 AIFs are basically the funds not for leveraging but for operational needs of any entities. These are all debt funds and fund of funds and private equity funds. Category 3 are the funds which are invested using complex trading techniques, private investment in public equity fund and hedge funds. So the size of the AIF is 9 lakh crores for the HNI individuals, and they invest in AIFs as an option beyond traditional equity and bonds. Then the AIFs are expected to be available to the mid-sized retail investors. AIFs normally offer higher returns, though it is having huge risks. Indian residents, NRIs and foreign nationals invest in AIFs with a minimum limit of 1 crore, whereas for directors, employees and fund managers, the minimum limit is 25 lakhs. There are certain minimum lock-in period for investing in AIFs, maybe 3 years, and number of investors in AIFs also restricted. So the withdrawal of the RBI, the regulatory forbearance by RBI, slowly RBI is removing many of the forbearance which it has allowed during the pandemic. So RBI has expanded the regulatory measures from retail to corporate. Earlier, RBI has issued certain guidelines with reference to retail loans. So forbearance are nothing but some kind of relief provided by the regulatory authorities during the pandemic is being improved by the Reserve Bank of India to overcome certain accumulation of the risks and also improve the health of the financial system. Thank you for watching Learn by Choice.